How is everybody doing today? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. So report week continues to roll on here. I got another great one for you today. We're going to be doing the 2025 Risk Review from the FDIC. We're going to be taking a look at that and what information does that tell us. But today, also being Thursday, this is the kickoff of Stony Year for 2025. Very excited for that. Wish nothing but the best to all the first-year students who are down there today, getting registered and checking in and getting rocking and rolling with their first classes and all that. So all the best to them as they begin their 3-year journey through the school there. So hope everything goes well. But let's dive into this report here. So this is the 2025 Risk Review, and if you would like to look at this report, there is a link to the report in the description down below if you want to go take a look at it. But let's blow this up a little bit so everyone can see it here. So again, this is about a 49-page report. So I'm going to try to break it down and keep it slim for you guys so that we're not here all day looking at this. But let's just run through the table of contents for a second. So we have the introduction, we have the executive summary, which we're going to be spending the most time on. Then it gets into section 2, which is an overview of conditions and banking performance. So which talks about economic and financial market conditions, banking performance overview. Then we get into section 3, which is market risks, and then section 4, which is credit risks. And that might be the area that a lot of people might have a lot of interest in, because it literally breaks down through all these different lending segments. So commercial real estate, non-depository financial institution lending, and private credit, which I think is a big one, consumer lending, residential real estate, corporate debt and leveraged lending, small business lending, agriculture lending, and energy lending. And then at the end, it has a whole acronyms and abbreviations and glossary of terms, which is always helpful. But let's get into the executive summary here. So economic conditions remain solid in 2024, and financial conditions remained generally stable. So economic growth exceeded expectations for much of 2024. Labor market growth slowed as the market came closer into balance. Inflation continued to ease but remained elevated, while short-term interest rates began to decline at the end of 2024. Longer-term interest rates remained elevated for much of the year. The yield curve remained inverted for most of 2024, but began to flatten in medium and longer maturities toward the end of the year. Interest rates remained elevated for much of the year, but shorter-term rates declined toward the end of the year. Overall, the banking industry was resilient in 2024, despite the challenges of an inverted yield curve and higher interest rates. The industry's full-year net income was well above pre-pandemic levels. Asset quality metrics remained favorable. Liquidity was stable, and capital levels increased. Deposits increased modestly in 2024. However, banks reported deterioration in certain loan portfolios and continued elevated levels of unrealized losses on securities. Community banks generally fared better than the rest of the industry during the year in deposit growth and loan growth rates, but reported higher growth in expenses, which reduced their income. So key risks to banks. So market risks continued to challenge the banking industry in 2024 with higher interest rates and an inverted yield curve during much of the year. The banking industry's annual net interest margin, the NMI, declined as growth in funding costs outpaced growth in asset yields. Lower interest rates may help ease funding cost pressures for the banks most negatively affected by higher interest rates in previous years. But interest rate uncertainty may be an ongoing challenge for banks overall. Even as short-term interest rates declined, banks continued to report unrealized losses in securities portfolios as longer-term rates remained elevated, representing a drag on future earnings. On-balance sheet liquidity levels were stable in 2024. Deposits increased for the first time since 2021 as uninsured deposit growth resumed. Wholesale funding growth slowed, and the ratio of wholesale funds to total assets was within pre-pandemic norms. So so obviously efficiency remains a big thing for banks, particularly community banks. Community banks have to really go after efficiency. Just a hint, about a week and a half ago, I dropped an episode I covered an article from Independent Banker Magazine, which basically looked at what are 9 things that you can do to really drive efficiency in your bank. Might want to check that episode out. Some good tips there. Carrying on here, credit risks varied by loan type in 2024, with greater asset quality deterioration in certain commercial real estate and consumer loan portfolios. So commercial real estate, CRE conditions varied by property type and market in 2024, with office underperforming other CRE types. CRE loan growth slowed in 2024. High interest rates continued to inhibit refinancing of CRE loans as borrowing costs rose, while higher operating costs, elevated vacancy rates, and slower rent growth weakened property level cash flows, while CRE asset quality weakened. Past due and non-accrual and net charge-off ratios remained far below levels reached during the Great Recession. Non-depository financial institutions lending and private credit. So bank lending to non-depository financial institutions is heavily concentrated in large banks and has grown in recent years. Growth in alternative assets, i.e. private credit, particularly private equity and private credit, has played a key role in the evolution and growth of NDFI lending. Despite some vulnerabilities in the NDFI market, bank lending to NDFIs has historically presented relatively low credit risk. However, and I am doing so, the Federal Reserve just came out with more research on private credit, which I'm going to be doing another episode on next week. So keep an eye out for that coming next week. I think private credit is a big problem. And if anybody asks me, where is the next big credit blow up going to be? Where is the next credit bubble forming? It's already formed in private credit. And when the next pop comes, my money is on private credit. That's where the big problem is going to be. And the problem is going to be all these private equity and hedge funds that do not have insurance, do not have FDIC insurance, that, not regulated. They're going to be running back to the Fed looking for a bailout. You mark my words. They're going to blow up and they're going to come back to the Fed saying, you got to bail us out. And they're going to say, oh, it's going to be like a domino effect. If you let all these hedge funds, these private equity funds go down, it's going to roll over to the banking industry and it's going to affect the whole financial system. You mark my words. I'm telling you. We'll see. Give it a year or so. We'll see what happens. We'll see if I'm right. All right. Consumer lending. Household finances were solid in 2024, but were weaker than in 23. Real income growth slowed, but remained positive, and household wealth rose. Debt burdens remained near historic lows, but rose from 2023 levels, and the savings rate fell. Debt burdens remained near historic lows. I don't agree with that one at all. What? When you look at the amount of mortgages, you look at the amount of auto debt over $1 trillion, credit card debt over $1 trillion, student loans over $1 trillion. Like, no, I don't think. I think we're at historic highs in debt, not lows. The savings rate fell. Consumer loan growth slowed as banks tightened lending standards and demand for loans eased. Asset quality worsened in 2024, but the pace of deterioration slowed. Residential real estate. So a limited supply of homes for sale and high mortgage rates continued to weigh on the housing market in 24. Home prices increased further last year, which contributed to lower housing affordability. The banking industry's residential mortgage balances continued to grow, but at a slower pace. Asset quality of residential mortgages held by banks remained generally sound. Corporate debt and leveraged lending. So corporate debt increased in 24 as market conditions improved, but high interest rates and inflation concerns continued to cause distress for some corporations. E-bank lending to businesses remained weak and underwriting standards remained tight in 24. Limited near-term corporate debt maturities could mitigate risks in the short term. Small business lending. Small businesses reported tighter financial conditions and higher inflation in 2024, but were supported by steady consumer spending. Community banks remained an important source of small business lending. Small business lending slowed during the year based on various measures, but asset quality for community bank, commercial and industrial, C&I loans, a proxy for small business loans, remained relatively sound in 2024. Agriculture lending. Agricultural conditions softened in 24 for the second consecutive year on weakness in the crop sector, and farm banks reported tighter liquidity positions as crop farmers increased borrowing. Despite operating losses for many crop farmers, agricultural loan quality reported by farm banks deteriorated only modestly in 2024, while farmers are generally well positioned to withstand weaker agricultural conditions. Projected losses for 2025, primarily on corn and soybeans, could impair their ability to repay loans, posing credit risks to banks. And then finally, we have energy. Oil prices were relatively stable in 24, and fundamentals of oil and gas companies generally remain sound. Large bank loan exposure to oil and gas firms declined further in 24, while asset quality improved. The asset quality of loans held by community banks headquartered in energy-concentrated states weakened slightly, but remained better than in previous years. So there you have it. And like I said, then it gets down into this, it gets down into a much deeper dive of each one of these categories, overview. So we get into section 2, overview of conditions and banking performance. A lot of, I think, really good charts in here that people could really dive into and take a look at. Banking performance, like we said, was pretty resilient. Here is a great chart on unrealized losses on investment securities remaining elevated year end. Obviously you look at the far right here and you could see that this is the 900-pound gorilla in the room, so to speak. This is an overhang that is just going to continue to hang on the banking industry for, quite some time until something, really changes with interest rates. Loan growth increased from 23, but remained subdued. And then we get into section 3, market risks, net interest margins, liquidity, and funding. So the banking industry's annual net interest margin declined as growth in funding costs outpaced growth in asset yields. In other words, funding costs. In other words, what the banks had to pay out on deposits. So that increased much. They had that outpaced the growth in loan yields. Obviously, a lot of loans, the banks are waiting for a lot of loans to mature because they're still at much lower interest rates. They're still at 3, 4, 5% from a few years back. As banks, as a lot of that debt starts to roll over, banks will start to get 6.5, 6.75, 7% on a lot of those loans, which will increase their margins, but that will take a little bit of time. Unrealized losses on securities were little changed. On balance sheet liquidity levels were stable. Deposits increased for the first time since 21. Wholesale funds declined from 23. Wholesale funds as a share of assets were within pre-pandemic norms. So that's all good. Again, a lot of great charts in here on a lot of that stuff. And then we get into credit risks, commercial real estate. Obviously, office sector is of main concern. I would say a little bit of concern there in multifamily and industrial. Retail. Amazingly, retail seems to be fine. That, retail for a long time was kind of like the problem child, but now, a little bit of vacancy there in multifamily and industrial. Obviously, so a little bit of issue there. Keep things to keep an eye on. Let's see here, and then as we get down, Obviously, box 1, introduction to private credit. I'll get into that, like I said, in future episodes. Consumer lending. So it just goes through all those different categories that we discussed. And we're almost down here to the bottom. Yep, and there you have it. So acronyms. I think I skipped through stuff. Energy lending. Okay. Just want to make sure I didn't miss anything. Okay. Acronyms, glossary terms, all that. Okay. And then there's the end of it. So there you have it, ladies and gentlemen. I think very good, very comprehensive risk review of basically what happened there in 2024 from the FDIC. Again, really good charts and graphs in this report if you want to go and dig in and take a look at it, but gives us a great snapshot, a great overview, a recap, if you will, of everything that happened there in 24. Also, some great glossary terms and acronyms at the end if you're just not familiar with some of this stuff and you want to familiarize yourself with some of these terms just to get a better understanding of a few of these things that are in there. But with that, I will wrap up by saying if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. Report week is going to roll on. I already had 3 great episodes out. We've got 4 more coming here over the next couple of days. So please stay tuned. I hope everyone has a great day out there, and I will see everyone again real soon. Thanks a lot.